Are you possibly paying more taxes than you need to? And are your retirement accounts positioned to help minimize that burden over your lifetime? Everyone has a different mix of account types and account balances. But what you need to understand is how they are taxed, which broadly falls into three categories. Pre-tax, also considered tax deferred. Most commonly, this will be a traditional IRA or traditional 401k. As funds grow, there are not annual tax consequences, but withdrawals from these accounts are generally taxable. Post-tax or tax-free, most commonly a Roth IRA or Roth 401k. If certain criteria is met, these funds grow tax-free and can be withdrawn completely tax-free. Then the taxable brokerage account. This is a non-retirement account. Funds go in, no tax deduction, and withdrawals are not taxed, but the activity within the account is taxed in the year that it happens. So interest, dividends, realized gains, etc. get taxed in the year that they occur. Now, I'm going to keep this concept as simple as possible. These account types are taxed differently, and you may be able to take the exact portfolio you have today, but shift which account holds which investments to optimize your portfolio from a tax standpoint. When implemented appropriately, this type of strategy may help reduce taxes over time and improve after-tax outcomes, meaning your retirement funds go further and, for lack of a better phrase, gives you more bang for your buck. If you would like a CFP professional to review your portfolio and discuss potential tax efficiency considerations, you can schedule a time with a link in the description. Now let's look at a hypothetical scenario to help explain this further. Let's look at a $1 million portfolio. It is 60% in pre-tax accounts, 20% in post-tax accounts, and 20% in taxable accounts. For purposes of this hypothetical example, this person has determined that they want a 70-30 asset location. So 70% in stock market investments and 30% in bonds or fixed income investments. If they're investing for convenience, they could put the $600,000 in pre-tax in a 70-30 portfolio, the $200,000 in Roth in a 70-30 portfolio, and the $200,000 in taxable brokerage accounts in a 70-30 portfolio. However, while this might be the convenient way to do it, this is not tax optimized. Now, I want to be clear, this video should not be misconstrued as individualized investment advice. You should only take investment advice from a professional who is familiar with your specific situation. But general concepts here. Now, I don't have a crystal ball. Nobody does. But many investors choose to place investments they expect to have the highest long-term growth potential inside the Roth IRA accounts, because future qualified growth and withdrawals can be tax-free. We want the taxable account to grow with the least amount of ongoing tax drag, so avoiding high income and high dividend producing investments or investments that are going to result in high taxable activity on an annual basis. That tax drag reduces the account's after-tax return. We also want to keep in mind that investments held in a taxable brokerage account for over 365 days could get the more favorable long-term capital gains treatment. And under current tax law, taxable assets may receive a bump up in cost basis at the passing of the account holder. Some investors may also benefit from evaluating tax loss harvesting or tax gain harvesting opportunities when appropriate in the taxable brokerage account. That is a topic that I'll dive into deeper in a future video. Hit subscribe so you don't miss out. Now, the pre-tax account, here's where we can hide the majority of the non-stock market investments. We obviously still want this account to grow over time, but while this account grows, the future tax liability may grow with it because it is pre-tax. So in the pre-tax accounts, we can place the most conservative part of your portfolio, as well as hiding the investments that produce the most taxable activity, like relatively high dividends and ongoing interest. I hope you found this video helpful. I encourage you to ask yourself the question I posed at the beginning of this video and explore further whether your retirement investment portfolio can be better set up in a tax-efficient manner. And as always, money is a tool, knowledge is freedom, and planning is power. I'll see you in the next video, and I hope you have a great rest of your day.